welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guest Ali Pashaei. Before we get started, quick disclosure: the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all the risks prior to placing any trades. Hypothetical computer simulator trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. Again, this is for educational purposes only. So with that out of the way, Ali, welcome back. This is not the first time you've been with us on the roundtable. It's always a pleasure to have you. So welcome.
Thank you. It's good to be back.
And Ray asked if you could share a little of your history with Charles Cottle. I know Charles, I told him that you were speaking the last time, and he said, Ali's a great guy. So you have a high endorsement from Charles.
Well, he's an incredible individual and trader himself.
Absolutely. So you helped him do some mentoring, I think?
Yeah. I mean, I consider myself I consider him my mentor. When I started out years ago, he was the one I would credit with helping me take my trading to the next level, if you will. And I got involved with him a little bit more, and I assisted him as part of one of his mentoring sessions as an assistant coach. So it was, I think, a 6-month-long mentoring session. So he's a great guy. He does a lot of good work.
Definitely. Okay, so I guess I need to give you the ball. Sorry about that.
No problem.
Make it easier for you to share your screen. Okay, you should have it now.
All right, let's see. What was that magic key?
You can go, there's a Control-Alt-D, like Delta.
Oh, there you go. Okay. All right. Let's see if you see my screen.
I do, long premium vertical spreads.
Great. All right. Let's get started. Let's see if there's a way for me to see the chat window.
You should have that thing up at the top of your screen. You'll see the chat up there.
Okay, great. Yep, there you go. Okay, and if there's any questions as I go through this, I would like people to feel free to jump in and ask questions. I don't have a lot of slides. What I wanted to do is just have a few to highlight a few key points and then jump into charts and the platform to kind of talk about the specific examples. So, feel free to, we can make this as interactive as you guys like versus just a monologue. But what I wanted to cover today, talk about a little bit about what I call long premium vertical spreads, which is essentially what a lot of people call debit spreads and how specifically I trade them. Here's my standard disclaimer, and I think Tom went through his. And the gist of it is basically that future results may be different than past results, and we can go back test and create simulated results, but that doesn't take into consideration slippage and other market factors and how things may change in the future. So, and options and trading is very risky in general, so you really need to understand things and learn how to do things before risking real money. A little bit about my background. Again, as Tom was mentioning, I've worked with Charles before, and I've been trading options since 2001. My first market experience was the 1987. Some of you may remember that as being a crash happening, and I happened to buy my first stock right before the crash, so that was not fun. I've been basically trading my own account and managing family funds, and I do consulting and mentoring, and this is my group. In case it's a Google group, in case you guys are interested, you can send me an email. I'll add you to it. So what is a long premium vertical? Essentially, it's the same thing as what a lot of people call a debit spread. I personally don't like the term debit spread because that could be misleading. It's essentially sorry, and this is wrong. It's negative. It's negative theta, not positive. So I'll correct that slide. It's short theta or negative theta, not that. Let's see. Let's correct that now. Okay. So here's, let me just show you what I mean by that. And some of you may already be familiar with it, but looking at any particular underlying, it doesn't matter. Again, it doesn't matter what we call these things. Essentially, everybody kind of understands if I buy a debit spread in SPX, or I can either buy a put spread like that, or I can buy a call spread, it doesn't matter. We call this a debit spread, and essentially we have negative theta and positive gamma. But I'm not sure if everyone fully understands this, that if you essentially flip the puts to calls, you'll end up with a credit spread. So if you essentially do or sell an in-the-money call spread, what you're doing is receiving a credit. So you can call that a credit spread if you like, but it has all the same exact characteristics as if you bought the equivalent put spread. As you see me flip this back and forth between puts and calls, you see that it's basically exact same structure in terms of the Greeks, P&L, and everything else. So to call an out-of-the-money long premium vertical a credit spread could be misleading for some people because they think just because they're getting a credit, it's a good thing. That's why I don't use that term, but it's a common term that's used, credit spreads and debit spreads, and I understand that. The other time that it becomes relevant is if I buy a call spread like this because let's say I'm bullish in SPX. Now, it starts out as being a long premium, meaning that I'm short thetas. However, as the market progresses and moves up, and let's say the S&P actually moves up to 2030, the theta slowly as the spread goes in the money becomes positive and the gamma becomes negative. So as the market progresses forward and moves up, you'll see that the theta turns positive. So just because a spread starts out as a long premium position, as the market moves around and moves through the center of it, it turns into a short premium spread, which is basically ends up being an in-the-money call spread, which is the same thing as an out-of-the-money put spread. So those are the kind of key distinctions to keep in mind, and understanding that is important, especially for folks that are trading things like butterflies. And I'm sure everybody has had a case where they have a spread that goes in the money or a long option for whatever reason that goes in the money. So now once it does that, then things flip around. I think Teddy's asking if it's at the money, theta is positive. It depends, Teddy. If by at the money, there is a thing called what I call an at the money vertical, and that's when you place a one leg in the money, one leg out of the money. I don't know if that's what you're referring to. Let me reset this. And this is what I would call a at-the-money vertical. It's because the center of it is vertical. I'm not sure if this is what you're referring to, but this is more of a neutral premium vertical spread where you're neither long nor short. Now, due to the skew that exists in the specific underlying, you may see the theta as being slightly negative or positive, because if you basically flip the same thing over to the puts, you'll see that despite the fact that this is also a neutral premium vertical spread, the theta flips slightly positive, and you get a bit better risk-reward ratio. So, but to keep the skew out of the picture for a second, this is sort of like an at-the-money, what I would call an at-the-money vertical or a neutral premium vertical. So that distinction is important. So how do I, and as I mentioned, there's different degrees of being short and long premium. It's not a static concept, right? So if I come out here and basically place a put vertical spread way out of the money at a pretty low delta level, you'll see that this is really negative theta, and you're very long premium, right? You start getting into the territory of being a lot more long gamma and short theta, et cetera. So there's degrees to it. So how do I use them? What do I do exactly with these things? Well, I think the usage that a lot of people are familiar with is hedging. So a lot of times people are hedging the downside with these positions. Hedging the upside, I do that if I am leaning too short and I need to pick up some long deltas. This is typically the first types of structures I'll look at. I use them for directional trading. I have trend following systems where I try to ride the trend as long as possible, and I have swing trading system where you want to be in and out. I use it for that, and I use them to buy volatility. So let's say you want to reduce risk in terms of volatility risk. You're short a lot of premium. There's a variety of ways of doing that, obviously. So you can go to the SPX and for, you're kind of nervous about the market. Let's say you have a pretty large position on. You can go out of the money and buy some premium or buy some volatility that way. You end up having long Vega position with this type of a vertical spread. Of course, there is, you're risking very little to make a lot, so this also provides a pretty good hedge. Now, there's other ways of doing it. You can also buy volatility in a product like VIX. Just remember, if you're trading VIX options, you're really not trading the index VIX. You're trading the VIX futures. So the options are actually on the futures, so you want to be careful. If you want to get a chart of what this looks like, you really don't want to be looking at the VIX chart, saying, okay, volatility is here, so let me go buy some calls. You really want to be looking at the VIX futures, and you want to match it to the expiration that you're purchasing. So there's these different VIX futures expirations, 7-day out, 14, 21, 28, which is being the active. So if I go out VIX to this expiration, that's the closest one. That's the one that I'll be trading if I'm buying the VIX options. You always, most of the time, under normal market conditions, which is what we're right now, you see that the VIX futures is actually higher than the VIX index itself because the futures are predicting a potential rise. So therefore, you want to be careful as to what you're doing. But here's a way to buy premium as far as buying volatility, which can serve as a good hedge for volatility. And these are the types of positions I had on prior to the both Brexit and the recent election to kind of hedge off the volatility risk, if you will. So that's a good way. The other thing that a lot of people are maybe not aware of is you can actually sell volatility with long premium vertical spreads. And this kind of surprises some people as to how can that be possible. I'll show you a recent example of how I did that. Now, how do we typically sell volatility? So let me talk about what I like to do. Is you see these spikes in VIX, right? I'm looking at the VIX chart. It doesn't matter. We could look at VIX or RVX or VXN. It doesn't. Whatever product you're trading, you get these periods of time, and this happens a few times a year. If you get into a really bad bear market, it happens a lot more. where you get a fairly good degree of spike in VIX. And what a lot of people want to do is when this happens, say, well, I'm going to go sell some volatility. Premiums are high, and I want to go take advantage of that. The normal method that option traders do that is by selling put premium. The put premiums that are sold are typically done via something like you can sell put spreads. That's one way. Broken wing butterflies is also pretty popular now. A lot of people are trading broken wing butterflies because it's a negative vega position, right? It doesn't matter what expiration you put these things on or how you structure them. It's very similar. The position ends up being long theta, short vega, meaning that you expect volatility to come down, and that's fine. These are good ways of doing it. And here's an alternative way of doing it. So here's my challenge with just going crazy and selling a ton of volatility when there is a spike in VIX. So the reality of it is that it works let's just say I'm making up a number here, 95% of the time. But it's that 5% of the time that oversold condition in the S&P, let's call it that, leads into something a lot crazier. So we saw that last August, right? So we saw the market having kind of been in a sideway motion. It broke support, and we saw what happened on the following Monday, where we had a very massive gap down in the market, and of course we had a period of choppiness going forward. We've also had 2 limit down moves in the ES this year. I'm not sure if people are aware of that, but when you look at the overnight of what happened during the election, I'm sure most of you are familiar what the ES did. And I think the other one was here, where we had 2 limit. Now, this is a kind of I can't recall the last time, and I've been trading options, like I said, since 2001. Something's changing in the overall markets. If we start seeing more of this types of crazy moves for whatever reason, either up or down, and we recently seeing this in the upside with the Russell, which is what it's doing, it wouldn't shock me, right, because it's becoming more of a common occurrence. So we're in an oversold situation in the S&P. I want to sell premium. Let's say I have done enough, as much as I want to do, as far as put structures on S&P. I don't want to add any more risk. So what do I end up doing? Well, here's where the long premium verticals come to the rescue. Of course, one way to do it, and I wouldn't call this exactly selling premium, but you could make an upside bet, right? You can buy a call spread out of the money in the S&P with the expectation of a rise. But I'm going to show you a different way of doing it. For that, I like to go to products like VXX or SVXY, and I typically look at either one to see which one's giving me a good risk-to-reward ratio. And the products are very similar. A lot of people like the UVXY, which is the ultra-short version of VXX. It's a leveraged version of VXX. But if you're, I don't want to take too much time going and describing the details of these specific products, but let me just put it this way. VXX, you might want to go kind of research this a bit. You don't want to be a long-term holder of VXX. Okay, this specific product has a tendency to move down, and it's not just the contango backwardation issue. I think it also has to be the inefficiencies that exist structurally in these types of leverage products or volatility products. SVXY is the inverse of VXX. So as volatility spikes, this thing will have a pullback, will have a sharp decline. like we saw here during the election. And as the volatility subsides or it declines, you'll see a rally in this product. So it works in a very similar way to S&P, SPX. If you compare the two, you'll see that there's very good degree of similarity between the two. So one of the things I did when I wanted to sell, and I show you the exact example, is on as the market was declining and we had a nice spike in VIX, which is right around here, I wanted to add some additional short premium to my position without taking a lot of risk. So what I did in order to do that came to SVXY, and I essentially bought an out-of-the-money call spread, a debit spread. So in a way, I'm taking a position that's short volatility, because as volatility declines, there's going to be a rise in this underlying product. But at the same time, so what's the advantage of that? So why not just go sell put structures? The advantage is that, and let me show you the position that I put on. So by the way, here's the, let's see here. This was an email I sent out to my group titled Selling Volatility a Different Way. And this is November 3rd, and this is what I sent out. And here's what I did. Let me just pull it up. So what I did was I started buying out-of-the-money call spreads in SVXY, and we were down here. Right now we have moved, and we're up here. So the spread that was long premium is now short premium, but the SVXY was down here. Let's see the exact level. Yeah, it was 65-ish. It was down to the 65-ish level. So what I came in, I bought this particular position. I ended up paying for a $10 wide vertical. I paid about $225 average price. So what I was doing is I was risking less to make a lot more. So what ends up happening is that if all of a sudden there's a massive crash in the market at that time and SVXY really tanks, all I'm going to lose is what I risk in my total spread. However, if I am right in that volatility actually does decline, there should be a good amount of rally in this, and this thing should make a good amount of money. So this is how I end up shorting volatility without really taking a huge amount of risk. And like I said, to me, this is a supplement to my normal trades that I do on the indexes, where I want to come in and take advantage of, like I said, these spikes in VIX and short premium. So as we all know, it's been a good deal of rally in SVXY. It has risen quite a bit, and it's still kind of doing okay. Now, question came in. Teddy's asking, how long do you expect to be in these trades? Good question, Teddy. My expectation is depends on the market condition. If we're in an overall bull market, what I try to do is try to capture as much of this type of a move. Something as much as I can, and I want to be able to ride the trend. If we're in a highly choppy, volatile, or a bearish market condition, yes, there's going to be these spikes in VIX. If we go back and look at the 2008 market condition, or we saw some of that, I think it was 2011, then I'm more of an in and out. And I will get into these things, and after a few days of a rally and a good percentage profit in the spread, I'll jump out. Now, on the current market conditions where we've been in this long-term bull market, and the S&P is breaking out, and you can measure the long-term trend in many different ways. I suggest keeping things simple. What I would do is just keep my analysis as simple as possible. Say, well, we're in a bull market. We have been in a bull market. Let's not get in the business of predicting the next big bear market until things start shifting. So based on that philosophy, I am trying to write this as much as I can. So what I ended up doing with this position is, as the market went up, so here's the thing. You could always put these things on and just leave them alone, right? Say, okay, I have my profit target, as soon as I hit it, and I'm out. And actually, that's a very good way to do it. I do it via GTC orders. After I buy them in, I'll just come in and throw a GTC order to just take me out. But in this case, as I mentioned, I want to be able to ride this. So what I did was I took half the position off at about $4. So now if I had waited, guess what it's worth now? It's almost $7. But that's part of the discipline of taking partial profits, so you don't necessarily go from being up good amount of money to down. So what I wanted to do is take out as much of my original investment as possible and play with the winnings. And then the other thing I did was I sold a call vertical against it and converted into this a condor, if you will. So now it went from a long premium position to a short premium position with all of my original investment out. If this thing goes to infinity or zero, I'm still going to make some money on it. Yet, and this is kind of normal, when you see the market rally, have a big move, it typically takes a little bit of time to digest things. So it kind of makes sense to get into a structure like this, at least for a short period of time, to let time decay work its way for you. Now, there's going to be some back and forth, I understand that, but here's the current position. I did something similar in VXX as well. So, and it started out something like this, and as it went in my favor, which is down. Remember, VXX moves down. It's the opposite of SVXY. So here's was right around the time I bought a put vertical underneath it, a long premium put vertical, and as it's been going down, I wanted to also adjust this to take out some of my original investments. So I sold some put spreads against it, and I also rolled in my longs to lock in some money as well. So now it has turned into a position that I'm playing with my winnings, and I have my original investment out. One thing I want to mention, you guys, and this is, I hear this a lot recently from certain educational firms out there that basically use the term risk-free spread, and say, we start out with such and such position, and then we adjust it into a risk-free position. Isn't it great to be in a risk-free position? I want to be careful with that, because if I keep telling myself I'm in a risk-free position, I put myself in a situation where I can give up what I have so far made in this position. So you really want to be very careful. So what they're really trying to tell you is that if this spread goes to zero, you will not lose your original investment. The term I like to use is not risk-free. I like to use, now I'm playing with markets money, with what I made. So this is very much analogous to you, let's say, going to Vegas, putting $50 out of your pocket, doubling it, then taking your original money, putting it back into your pocket, saying, now I'm playing with my winnings. Now, that money was yours, right? So this money is mine. I could take it now. So the fact that if I let this thing go to zero, I'm giving up my winnings. So you want to be very careful with this concept of risk-free. This is not risk-free, and therefore you need to be aware that you could lose what you've made. So just want to point that out. All right, so that was the example. Let me just cover a couple of more points here. So why do I trade these? There is obviously a better risk to reward. And as I mentioned earlier, markets are changing. My perspective is this. I've always been big premium seller. I love selling premium in SPX. That's my main core trade. But what I like to do is diversify and not over leverage my position, because I'm really concerned with those massive move downs or up. And so I want to be able to have other ways of trading the market without putting myself in a situation where I can take a huge loss, because that's a no-no. So to me, I'm always looking at risk-reward as a way of playing the market. So long premium verticals give me really good risk-reward, as you just saw the example. They're very easy to fill. Market makers love these structures because they can take the other side very easily. It's a lot easier to get in and out of a vertical than to get in and out of a butterfly or a condor or a ratio condor or whatever it might be. The more complicated the structure, the more difficult the fill is, which is important, especially during those volatile times where the market makes big moves and we want to be able to get in and out quickly. They can be high probability. So here's the big argument against a so-called debit spread is that, okay, Ali, this is all good, but you know what? This is nothing that I see. For example, let's just go back to SPX. It doesn't matter what product. You can be in a stock or whatever. But I can't just see myself constantly coming into any stock or an index and trying to place a long premium position, because these things will negative theta. I'm losing $10 a day, so this is not good. And this is also a low probability trade, right? This is what most people are taught, that you're looking at a normal distribution. You're always basing things on what the delta is and what's the likelihood of a market going up or down, et cetera, based on the normal distribution curve, and therefore this is a low probability trade, so it's not good. Well, let's see if we can turn that around. There's a few ways of doing it. One is if you have a above average timing model, and I'll show you guys how to do that. It's not hard. If you manage the position, in other words, you saw with the example of SPXY, I didn't just buy it and sit in it. You could use GTC orders, etc. You could roll them, convert them, etc. So you can manage the position to increase probability. And there's also the volatility edge, which I mentioned, such as trading VXX and SPXY, because these products, especially if you look at the VXX, it trends down, and that's what it does. And it's been doing that since inception. And other than these periods of spikes that it goes through, it essentially trends down. So there's in my view at least, there's an edge in trading them. I'm going to get a little bit more specific on this in just a second. And the other reason I like to trade them is essentially they're the building blocks of almost many other same expiration trades, right? So by trading them, you get better at them, so you're able to manage positions and understand the vertical pricing, the pricing of these vertical spreads a lot better. So in other words, let's say I am in an SPX broken wing butterfly, and I use that because I know a lot of people trade it. And market starts falling, and I want to hedge my position. Well, if I have a good amount of experience trading vertical spreads, if I understand the notion of should I be buying a 20 wide, 25 wide, 10 wide, where do I place it, how far out of the money, what expiration should I go to, things like that, you could end up. And then how do you manage that vertical spread going forward? Sure, of course, you could trade in a very systematic way, right? You're following a rule book that says when this happens, do that exactly. But in my view, if people want to eventually get past that point of just following a formula and start developing their own techniques and approaches for the market, then you want to really get good at it. And understanding and learning vertical spreads in general, I think it's step one. It's the key thing that everyone should focus on. So let me pause real quick here. I want to talk a little bit about how to turn them into a bit of a higher probability trade. I want to see if there's any questions that are out there that I might have missed, because I'm talking really fast.
I think you're good. There was just a comment about the risk-free, and I typed in there that it just means you're risking unrealized profits. And if you think about it, if you close your position and open it up, would still be risk-free?
Exactly. That's exactly the point. And Tom brings out a really good point. What I like to do, and here's a technique. What happened here? If you're in any kind of a position that there you go. If you're in any kind of a position, what you want to do, instead of looking at this position with the eye of whether you're up or down money now, what you want to do is you want to look at it with its current value. Right? So if I turn all of these off and look at what that condor is worth as of right now, that gives you what a real sense is how much you're risking, which is about 5 in this particular position, risking $5,000 to maybe make 5. So this is the real position as of right now, not the earnings. So this is really a good way of getting a better sense of whether you should stay in a position or whether you should adjust it. That's a very important point.
Now, there were a couple other questions. What if VXX gets too low and they rejigger the share structure?
So they typically announce that there's going to be a reverse split coming up, and your option positions, if you are in any, just like any other product that goes through either split or a reverse split, will essentially reflect that. So your number of contracts will change. Now, what I typically do is not to go through that trouble, and I've been through those number of times where I'm in something and it goes through a split or reverse split, and now I'm looking at all these odd option values, etc. What I try to do is get out of my position before that and wait for the next signal to go back in.
And then Steve asked a question about what strikes to use in your debit spreads. See that one?
Right. The strike selection, I'll give you the gist of it, but there's a lot to talk about there to actually be able to cover it, and it would somewhat be unfair for me just to kind of give you a quick overview and be done with it. It's really an in-depth discussion, but what I typically do is, like I mentioned, if I am, let's get rid of these. I'm typically looking at a good degree of risk-reward ratio. I want to see something at usually when I'm buying something out of the money, I want to risk 1 to make 2 or 3, and I'm typically looking in the neighborhood of delta 45 to 30 range. In that range as being able to buy something, and then being able to sell something against it to reduce the risk of that long premium and still give me that 1 to 3 risk to reward ratio, or 1 to 2. So now that's the general area I start looking. However, to me, it really has to do with the expectation of how big of a move do I think the market's about to make, right? So if you look at SVXY, pre-election, there's a lot of perceived risk. My expectation was for volatility to calm down, and irrespective of who wins, the uncertainty factor has been removed, so that gave me a good degree of confidence in the trade. Besides, I trade mostly on technicals, so to me, all of these dips are different. Market, every time it dips, if you listen to the news, it's something different, right? One time is election, next time is China this, next time is news that. But what do they all have in common? You get this massive push to one side, especially in a bull market, then you get a reversal of that. That's very common. So if my expectation is for a big rally in that underlying, I like to go further out of the money, risk less to make even more when I expect a big explosive move. If I think the move is not going to be explosive, if you're trading something like, I don't know, now some of these stocks have been making big moves too, but if you're trading a slow-moving product, and maybe these days it's hard to find, but Walmart or whatever, where just the moves are not there, then I come in closer to the money, right? So it's basically that's kind of like a overview of it. Yeah, GE, exactly. All right. So I just want to make sure I have enough time to show you guys this. This is going to be interesting. I want to almost bet that most people don't know what I'm about to show them. Never. Some people may do, but I think most people that I've talked to will be surprised with this. So just talking about turning these things into a bit of a high probability. How do you increase the win rate without market timing? So let's say you're really not good at market timing whatsoever. You have no clue, and you say, I'm not good at it. Now, what's the common thing we hear about out there with regards to market timing? You see a lot of people say, well, some of the best directional traders are only right 40% of the time. That's pretty common. Or, betting on the market direction is a 50-50 game. You lose half, it's a wash. There is no edge unless you have a market timing. Well, let me show you why that is not an accurate statement. And it's quite simple. Let me pull up this. So here's a trading strategy that you're looking at, and it's a mechanical test. And it uses random entry, meaning that it just, on a flip of a coin, decides whether to go long or short. So there's really no market timing involved. On a day-to-day basis, on every day, if it's out of the market, it flips a coin. If it's heads, it goes in. If it's tails, it stays out, right? So there's really no pattern in when it's going to get into the market. Now, if I show you the performance of this, and I ran this on S&P from 2012 until present, it's right 95% of the time, and it's made $97,000 versus buy and hold 91. I think the trade size is just buying 1,000 shares. Yep. So here's the green line you see, the green area you see is the P&L of this mechanical system, and the blue line is the actual S&P during that time. And I can go back and say, use all the data. It doesn't matter. You're going to get, if you get bear markets, you see this diminish. In bull markets, it rises. In bear markets, because it's a long position, right, so it stays with the market. And the probability of wins stays at 90%. So how is that possible? It's a very easy trick. It's a very easy trick. All I did was set my profit target to be 1%. So as soon as there's 1% profit, I get out, and I set my stop loss at 8%. So all this is doing is saying set a stop loss at 8%, set a profit target at 1%, and voila, I have myself a high probability trading system without any market timing. If I start changing this formula and go from 8% to 4% stop loss, you'll notice that it went to 85%. How about if I risk 2 to make 1? Run it again, 70%. You see the pattern? How about where a lot of traders say, no, I want to risk 1% to make 3%. Let's try that. It's 34%. And no, that's the reason why you see, that's how you manipulate probability. So it's not a special privilege of us option traders. There is an edge in selling volatility, don't get me wrong. But just because you go sell a Delta 10 put, which only has 10% of being in the money by expiration, it doesn't necessarily mean that because it's an option, it's what's giving you the high probability. It's because you're risking a lot more to make less. Now, to flip that into actual positive expectancy, which means you make money, you need to have an edge. And the edge may come from the fact that options are overvalued. That means you have a timing model, etc. So it's actually quite easy to take a vertical, short premium vertical system like this that we were talking about, where you go buy something out of the money like that and turn it into a higher probability trade. And how do you do that? The way you do it is by setting tighter exit points. So if you, for example, for whatever reason, you don't like the low probability stuff, you don't want to be right 1 out of 4 times. You want to be right 4 out of 4 times and lose 1. So you want to be right 70%, 80%. All you really need to do is exit quicker, get out of the ones that are profitable quicker, and that's all that does that. So there's really no magic in being able to increase the probability. All you have to do is set a smaller profit target and be able to risk more. So that's essentially dispels that myth. The other thing that I want to add to that is now once you start bringing in some type of an edge into the whole picture, like we talked about, there's a volatility edge, right? Volatility has a good chance of subsiding after it spikes. Yes, Thomas is mentioning make sure you're protecting the code from hindsight. Absolutely, there's no hindsight. So what he's referring to is sometimes when people write scripts, what they're doing is they're essentially when they get the signal, they're taking that days as if they're looking at that ahead, 1 day ahead, and they're taking a signal, and that could be very misleading. So you have to be very careful how you code this stuff. Yeah, thanks for bringing that up. So volatility is an edge, like I showed in the example. The other one is having some type of a system that gives you some type of an edge. It's actually a good thing. Let me show you guys what I mean by that. Here's a very simple system that I'm going to show you. And what it does is using a and those of you who know me, you've heard me talk about this a number of times. It says I continuously find that there is an edge in buying dips and selling rallies or exiting into rallies versus buying rallies. And that's not necessarily true in every product, but in the indexes, especially in the equity indexes, that's quite a common pattern. So here's a system that end of day when the market is closing down, such as a 5-period RSI is below the 45 level, whatever that level might be. So you look at your RSI at the end of the day and you say, okay, it's below 45, 5 minutes before the close, 2 minutes, doesn't matter. You buy, and near the end of the day, you look at your RSI 5 level. If it's above the 55 level, you exit, and you repeat and rinse. Now, you could also flip that to buying the open the next day instead of the close, but the results are very similar. They're not very different. And I've tested this 100 ways back and forth. And by the way, I've been trading this way for a long time, so I have real experience with this. If you just take this very simple system of trying to quantify a dip and get out on a rally, and you look at the performance of it, you'll see that it's giving you a pretty good percentage performance with smaller drawdowns than buy and hold. Now, if I flip that around and say, what if we did the other way around? What if we actually bought on strength, meaning that if RSI went over a certain threshold, we bought and stayed in the position until it dipped below it, right? So you'll see that if you did that, you'll be able to catch this big winners. It for example, entered here, where it went above that level, really didn't dip below until here, so you caught this big move. But you have to look at things collectively. If we look at this, we'll see that it has seriously underperformed. I mean, it's besides the fact that it has a low win rate. Look at the returns on it, $4,000 versus $79,000 of essentially buying dips. Now, when you buy dips like that, you're going to create and without using stops again, you're going to create a average win that's smaller than an average loss, right? But again, what we care about is the expectancies, not just the average win-loss. It's that multiplied by the win percentage that gives you the expectancy. So that's what we're interested in. So what the moral of the story is that everything I do, on the index products that I trade, every time there is a dip, without an exception, I get long. No questions asked. Now, the degree to which I get long varies, depending on market conditions, depending on my timing models and systems, etc. But this morning we had a dip. And that's just the intraday dip. I sold some put spreads. So without exception, and I want to say this goes back to many years now. I want to say back to 2010, I started doing this. For the last 7 years, every time there's a dip, I'm buying. The only thing I got to manage is my risk, meaning I don't want to be caught with one of those outlier moves where you lose a ton of money, right? So what is the safest way to do that, in my view, is by risking less to make more. Let me share with you guys a study we did, me and a group of people, back in 2010, and show you the results of what we did of a very similar system. Instead of a 5-period RSI, we're using a 2-period RSI, which is even more volatile, but same concept, mean reversion, buying dips. Now, let me add this. As option traders, here's the advantage we have. If I'm a stock trader and there's a dip and I buy, and I don't use a stop, my risk is potentially large, right? Meaning that there could be a crash. Most crashes happen from oversold positions. So there could be a big crash and I could lose a lot of money. We as option traders, we have an advantage in that we can construct limited risk, defined risk positions and say that if I'm buying a vertical spread, if it even goes to zero, whoop-de-doo, that's my risk. So that is how I control risk in my position, and I'm not worried about setting stops on these things. Let me show you the study. So so what I did, or what we did, we took a 5-year period of 2005 all the way through 2010, 5-year period. We took so that included a bull market, a crazy bear market of 2008, sideways market. It included the 2007 up and some choppy years, etc. So it included all sorts of market conditions. The system went both long and short, and basically said that if we're above the 200-day moving average, we're just going to trade bullish signals. If we're below the 200-day moving average, all we're going to do is trade bearish signals. So I generated the signals using WealthLab, buy, sell, buy, sell. Then we went and one at a time, we went to Thinkorswim, used the ThinkBack data, 1 day at a time, traded these with options, the signals with options. And we tested it with credit spreads, we tested it with debit spreads, and we tested it with long-only options, right? So, and here's the end result. Here's the credit spread, right? You see that it obviously it did well. It's a high probability thing. You're selling your credit spread into a dip. You have defined risk, so that's a good thing. A debit spread made more money. Okay, it made more money, and obviously was more choppier. You see the P&L compared the two. That's kind of typical. But let me show you the long, and this is the long. And let me tell you about the position size. We would get maximum of 10 contracts. So we would buy, we would start scaling in. So we start with 1 contract, and if it goes further against us, we would add to it 2 contracts and go all the way up to maximum 10. So that's our position size. That means the worst thing on earth that could happen, you could lose that 10 lot worth of whatever spread you did. So here's the results from the just being the long call. It made 18 grand on this simulation. We took commission and slippage into account. We said $1.50 per contract and a penny slippage. Of course, the results are not going to be identical in real life, right? But at least from a simulation perspective, it's pretty good. 18 grand versus the credit spread, 3,500. So when I hear that buying options is not it's a loser's game, it's not 100% true. Buying premium can actually work if you have any kind of a decent timing model and you give yourself enough time to win in that position, and you're managing the position correctly. And like I mentioned, since then, there's not a dip that has happened since then that I have not bought into. And it's been working very well for me personally. Can't guarantee that will be into the future or it will work for other people, but I can just tell you what I do. So here's the other way of increasing your timing model by incorporating some type of a mean reversion, especially when we're talking about the indexes. And of course, having some kind of a simple trend model, right? It doesn't have to be fancy. It could be just a couple of moving averages, crossover moving averages that you're following. The key thing, in my opinion, is that when I am in a winning position, like I was showing you with this SVXY, if I'm in a position where it's going in my favor, what I want to do is to prevent getting hit by a whipsaw, meaning that the market's going in my favor. I got in here and it's going up, 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 up. There's nothing that's going to stop the market from doing that, right? What I want to do is put myself in a position that as the market goes in my favor, I lock in my gains so that even if it goes back to the original position, I'm not losing as much, or I'm walking away with a scratch, or I'm walking away with a small win, and not taking a loss. So to me, that's a key thing, to be able to ride trends in any of these stocks or indexes with this. And you could use a very simple crossover moving average system. Of course, if your timing is better, the better you do. Just to show you an example of a good timing system, here's that simple RSI strategy that I just showed you, right, for the last. Now, you could take this concept of mean reversion and tweak it and turn it and convert it into something, let's call it smarter. And here's the equity curve of a system that I taught in the SPY weekly class to the folks, and they have the exact rules for this. And this system, you see how it has a very smooth equity, and this is a long only. And I can go back and show you the result of it all the way to the beginning of time, and you see how it did. And this is a long only, not short, long only. Notice how it did during the 2001 and 2 bear market, 2008 bear market, and what it's been doing. And here's the track record for this year. So far, no losses, and since 2015, it took a couple of losses for the last couple of years. And the overall performance is 83% winners win rate. If I bring that to a more current time frame, it's 91%. And I know some folks in the forum been posting that have been trading this, and they like it a lot. So, but the point is this, is that you can take a mean reversion system and convert it into something really good, and then add to that something like a high reward, low risk spread, and do really well with it. So here's the key things with the risk reward. I did mention on those out of the money ones, I really like to get 1 to 2 or 1 to 3 risk reward ratio. But if I am not too comfortable, if it's a slow moving product, or if I expect the move not to be a huge, massive move to the upside or the downside, I want to be able to get at least a 1-to-1. And I think some people, and that gets into more of the one leg in the money, one leg out of the money type of a vertical spread, or, you know, buying right at the money and selling slightly out of the money, etc. And the other thing I want to point out is you're not limited by the width of the spread, right? So don't be deceived by the fact that when you look at a position like this that says, okay, I'm buying a vertical spread here. Well, I am risking whatever, in this case, $170 to make 180. So that's the extent of how much I can make in this. That is the extent of the static structure, right? So what you can do is you can roll this up. There's nothing that stops you from rolling up that says it's gone in my favor. Now it's reached this level. I'm going to close this and roll it up. And by rolling this up, you'll keep opening up the upside. So you can ride this for as long as you want. So the risk reward that I'm talking about is just the initial position. Teddy's asking, what expirations do you look at? 30, 50? Good question, Teddy. The rule of thumb, what I like to do is it goes back into some of my, again, the timing models that I use that I'm looking at. If my expectation, and for these short-term mean reversion systems, most of them, if you look at the average time in the market, average bars held, this is like in that system I was showing you, it's basically 7 days, right, on average. So what I don't want to do with these is to buy 7-day options, that's for sure. So what I'm typically doing is looking at least double or triple that, if not more, just to give myself more room. Now, if I buy a 2-week, if I go out 14 days and buy this and there's a quick rally, I'll make a lot more on that spread if I had gone out 30. So, however, if you go out 30 days, you make less, but you're more likely to win. So you're increasing your probability, by going out further in time. And that's a good point because that gives you further increases in your probability than if you would just go short term, right? So we were talking about probability, and that's a good point. Go out in time, go out 60 days, go out 90 days, and you make less, but you increase your probability, and that's the trade-off. Personally, and here's what I do. I have been doing this for so long that I have a fairly good intuition about the market, especially S&P. So I stay within the 30 days, so right around that time, 20, 30 days. But if I was starting out, I would say I would rather go further out just to make sure I get a hang of this. So that would be my way. All right, let's see if I got any more slides left. Well, final slide. I just want to point out that there are so much you can do with vertical spreads. I know a lot of times people just start out by learning one strategy, whether it's a condor, a butterfly, or broken wing butterfly, and saying, I just want to trade this formula and make money, and that's good. That's a really good way of getting started. But what I would suggest is, a lot of times when I talk to folks and say, well, how do you understand vertical spread? Oh, yeah, I passed that. I learned that in my, week one of what a vertical spread is. There's so much deeper you can go into just the plain old vertical spread. There are so many different ways of adjusting them. You can, there's all this kind of details with regards to spread width. And I'm not talking Greeks. I'm not talking just going by the Greeks. I'm talking about pricing, right? Should I buy a 5 wide, 10 wide, 15 wide, 20 wide in S&P? What's the difference? Should I buy 2 of the 5 wide or 1 of the 10 wide? There's going to be differences. There's a concept of understanding what a box is, which is typically says, well, those are market makers. We don't need to know this stuff. No. If you ever had an option leg go in the money and you had to roll that leg for whatever reason, if you ever got filled immediately and you went, wow, that filled quick, then you could benefit from understanding what synthetics are, from understanding what a box is, because you could potentially end up paying a lot more for your rolls and adjusting those options that are in the money if you don't understand this. There's risk reversals, which I really like, and that's basically buying my call spread but financing it by selling a put spread underneath it. Those positions I really like. I mean, those are made up of vertical spreads. There's the whole set of adjustments you can do in converting verticals into what I call wing spreads, which is either condors or butterflies, things with wings, the spreads that have wings in them. There's alternative ways of taking profits with verticals. It's not just get in and get out. There's all sorts of rolling and things you can do with them. I'm talking all same expiration stuff. And understanding, like I said, what is the right vertical to buy and sell. And there's things you can do that's very interesting with regards to position sizing and compounding. Right? There's, what's a good bet size to begin with, and how do I compound my earnings? You can do that with risk more to make less. I mean, which is the typical stuff a lot of us trade, which is an out of the money credit spread or some type of a condor. But when you start talking about risk less to make more, whether that's just the plain old long option, or whether that's a long premium vertical, there are very interesting things you can do when it comes to compounding that you can't easily do with the risk more to make less. So anyway, my point here is that it's a very deep and broad field, and I recommend for everyone to start digging deeper into vertical spreads, specifically debits, because they're quite fascinating. There's a lot you can do with them. All right, so that's it. I think I went a little bit over the 1 hour limit, Tom, but hopefully.
Well, it's not a hard and fast limit. If it's a good presentation, just let her go. So it's not a problem, Ali.
All right, great. So if there's any questions or anything you guys want me to cover or answer, I'll be more than happy to answer that.
There's a question about where to take a class on buying the dip strategy. Is that the SPY weekly strategy?
So the SPY weekly strategy, it's about selling. It's about a strategy I've been doing in SPY, not SPX, SPY for a number of years, and I've refined it, and it's my latest incarnation of it. The bulk of the class is about what position I put on in SPY, how I manage it. In class 2, I share this specific, the rules of this specific timing model that I was showing you here, and exactly when to get in and get out. Now, it doesn't go into depth and details of all the nuances of trading mean reversion, but it does give you the rules for this specifically. And I added this because some people may just want to trade credit spreads. Other people may want to do debit spreads or just plain old long options in the indexes, and they could use it for that as well.
And I put the links in the chat to the 2 classes that you taught before, so if people don't have those already, then that's an easy way to get to it.
Right. Yeah, I just want to emphasize that it was a 3-part class, so it's 3 sessions. I think total of over 6.5 maybe hours. Bulk of it was the strategy and managing it. And it was class 2 that I basically, for about 45 minutes, half an hour, went over to this specific mechanical system and what the rules are.
And it does include access to Ali via the forums for the people that took the class. So it's a nice package. If you want to learn the strategy and if you still have questions, you can ask Ali. So it's if you're considering that, it's a good bargain. And Andrew asked, do you have an update to the SPY strategy targeted for SPX?
So at the end of the class, I mentioned to people that I'm looking at implementing it in the SPX instead of SPY. It has to be tweaked. It has to be changed a little bit because it's a product that's 10 times. The SPY strategy for me was really designed to be a no leverage or a low leverage strategy, more like a cash secured kind of a put selling or slight leverage, let's say 2 times cash. Now, when we're talking SPX, which is 10 times bigger, rules change a bit. There's a bigger risk to the downside, etc. So, short answer, I'm still working on it, Andrew. I really want to take it through its pace and have it actually have traded it myself before I feel comfortable, sharing it with other people. But that's still work in progress.
Well, very good. Well, I don't see any more questions. So thanks, Ali, for taking the time. Great presentation. Really nice ideas, and I hope people can learn from it. And if they want to take it further, take your class.
Great. Good to know. You guys have my email. I don't know if you do, but if you have questions, feel free to email me. And I have a Google group where we discuss trades there as well. If you're interested, that's free to join.
Great. And the forum access is for the people who bought the class. But the Google group one is free. So I think that'll do it.
Okay.
So thanks a lot, Ali, and thanks everyone for joining us. And I'll get this recording posted as soon as I can.
All right. Thanks, everyone. Have a great day.
Ali, thank you very much.
All right. Thank you.
Right. Bye-bye.
Bye-bye.